All right, I have 2 o'clock Central Time, so I think we'll go ahead and start it. Thank you, everybody, for joining today's webinar, Congress Considering Changes to Retirement Plans. Before I hand it over to John, I just want to do a little bit of housekeeping. I did mute the entire audience on arrival, so at the very end, John is going to take some questions, obviously. And so just go ahead and unmute yourselves and ask those questions. Let's hold on to those until the end. As John said, his prepared remarks will probably be about 45 to 50 minutes or so, and then we'll take questions at the end. So with that, I will hand it over to John.
Thank you, Jason, and thank you for your technical support. Good afternoon and welcome. As Jason noted, I'll be glad to take any questions after the presentation. Alternatively, if you prefer, my contact information is on the last slide of the presentation, and you're always welcome to give me a call or shoot an email if you have any questions about this presentation, about retirement plans in general, or if you have specific questions about your plan. Feel free to contact me at any time. Now, the subject of this webinar is Congress considering changes to retirement plans. Now, I typically don't concern myself too much with the minutia of proposed legislation because it's just that. It's proposed legislation, and as you know, whether it's retirement plan related legislation or other types of legislation, very often proposed legislation doesn't become law, and it's usually when it becomes law that I really start diving into the details. However, I do think that it's worthwhile to take a look at some of the various retirement plan proposals out there and some of the major provisions in those proposals, because I believe they serve as a guidepost of where we're headed in the retirement plan area. So what we're going to do today is kind of talk about where we are right now with the Secure Act, kind of review some of the major provisions of the Secure Act which are in play right now. Then we're going to talk about House's what is being called Secure Act 2.0, and the Senate has kind of a companion bill introduced by Senators Cardin and Portman that I'm going to call the Cardin-Portman bill. And then we're going to close with a discussion of the Democrats' Build Back Better Act, which is the $3.5 trillion budget reconciliation bill that does have some retirement plan related legislation in there. So I doubt that all of the proposals are going to be passed into law, but I do think there's a pretty likelihood that many of these provisions are going to become law, if not this year, in the next year or so. So again, it makes sense, I think, to at least take a peek at where I think we're headed. But first, let's take a look at the Secure Act, what we're dealing with right now. And so this was signed into law on December 20th, 2019 as part of a larger spending bills, and most of those provisions became effective 1/1 of 20. And there were 3 state policy objectives for the initial Secure Act. First of all, it was to help workers who have saved too little to save more for retirement. Second, it was to help expand worker access to 401k plans. And finally, it was to encourage small employers to adopt 401k plans. And I mention that here because when we talk about the proposed legislation, you'll be able to tell directly that this is what Congress wants to have happen. More people to save more money for retirement. And as I was preparing this presentation, I saw a nationally based employee benefits law group provide some statistics that 90% of employers with 100 or more employees have a retirement plan. Contrast that with less than 50% of employers with less than 100 employees have a retirement plan, with about a third of American workers without a retirement plan at all. So what Congress wants to do is to have more people save more money for retirement, and that's what happened in the Secure Act, and that's what's happened with the proposed legislation that we're going to talk about. So what the Secure Act did, first of all, to encourage employers to adopt plans, is that it enhanced the startup plan tax credit. So before Secure, there was a 3-year $500 tax credit if you were a small employer, and that's no more than 100 employees with at least $5,000 of compensation. What the Secure Act did, and here's the convoluted formula to determine what you can get, but basically you can get up to $5,000 a year tax credit for 3 years, covering 50% of your qualified startup costs. Qualified startup costs meaning what you pay to put your document in place, any kind of plan setup fees, 5,500 fees, compliance testing, administration fees, and participant education. But if you work through this formula, for example, at the bottom, if you have 3 non-highly compensated employees in your startup plan, you can get a $750 tax credit, which is already $250 more than the previous law. And if you have 20 non-highly compensated employees, you can get that $5,000 tax credit for 3 years. So an enhanced startup plan tax credit. And what the Secure Act also did was create this brand new tax credit for small employers with existing plans that add an eligible automatic contribution arrangement. That's a specific type of automatic contribution arrangement, but if you're an employer with no more than 100 employees with $5,000 worth of compensation, and you add an eligible automatic contribution arrangement to your plan, then you can get a $500 tax credit for the 3 taxable year period, beginning with the first taxable year that you add that eligible automatic contribution arrangement. So already we can see, if we don't talk about anything else the rest of the hour, Congress wants small employers to adopt plans, and they really like automatic contribution arrangements, and you'll see that that also bears out with the proposed legislation. Now, some of the substance of Secure Act, and this is really important, this concept of long-term part-time employees being required to participate in the 401k portion of your plan. So we've got to figure out who is a long-term part-time employee. But before we do that, you should keep in mind that even though you have to let these long-term part-time employees into your 401k portion of the plan, no employer contributions need to be made to these long-term part-time employees. So they don't have to receive a match, they don't have to receive a non-elective sharing contribution, they don't have to receive safe harbor contributions. You just have to let them into the 401k portion of your plan. So if you have part-time employees, you need to be aware of this rule. So let's say, for example, that you have a 1 year of eligibility service requirement. You require employees to have 1,000 hours in a computation period to get into the plan. Well, if you have long-term part-time employees, they need to get into the 401k portion of the plan the earlier of after they satisfy your normal, let's say 1 year of service requirements, or they have 3 consecutive 12-month periods where the employee has at least 500 hours of service. And you don't need to track service for eligibility purposes until January 1, 2021. And I skipped a bullet point toward the top there, that third bullet point, the arrow. While I did mention you don't need to let these long-term part-time employees into the employer contribution portion of the plan, Secure Act had a quirky provision that if you do want to be generous and let the long-term part-time employees into your plan for purposes of employer contributions, they will receive a year of vesting service if they have 500 hours of service. So understand what I'm saying here. Let's say you have matching contributions in plan, and you have a 6-year graded vesting schedule on matching contributions, and to receive a year of vesting service, you need 1,000 hours of service in the plan year to get a year of vesting service. Well, if you're generous and you let a long-term part-time employee into your matching contribution portion of the plan, that long-term part-time employee will receive a year of vesting service at 500 hours of service. So half of what your regular employees would need to get for vesting. So it's a real quirky provision in Secure Act. There's a House bill that straightens that out if it gets passed, but you should be aware if you decide to deal with long-term part-time employees by just letting them into the employer portion of the plan. If you have a vesting schedule, be aware of this 500 hours of service. You could simply let everybody into your plan and take long-term part-time employees off the table completely. It's just that if you have these long-term part-time employees that wouldn't otherwise become eligible to participate in your plan, and you let those folks into the employer contribution portion of the plan, keep in mind that quirky 500-hour of service rule for vesting purposes. So let's work through an example for the long-term part-time employee. We've got a calendar year plan year with January 1 and July 1 entry dates. We hire our employee on July 25th, 2021. Our employee works 750 hours from July 25th, 21 to July 24th, 2022. Works 600 hours of service in the 2022 plan year, and works 500 hours of service in the 2023 plan year. Now, this employee has 3 consecutive years with at least 500 hours of service as of 12/31/23. That means our employee must enter the 401k portion of the plan on 1/1/24. Now, keep in mind a couple of things. Let's say, for example, in the 2022 plan year, that our employee only worked 499 hours, and then again worked 500 hours in the 2023 calendar year plan year. We now start that 3 consecutive year clock again with the 2023 plan year. We don't have 3 consecutive years anymore because during 2022, our employee only worked 499 hours. So you need to have 3 consecutive years of at least 500 hours of service. Now, the other thing you should keep in mind, let's say, for example, you've got a 1-year of service requirement, and our employee, we were on the road to becoming a long-term part-time employee, but during the 2022 plan year, our employee worked 1,000 hours. Well, now they're no longer a long-term part-time employee. They've actually satisfied your regular 1,000-hour 1-year of service requirement in 2022, so that person would get into the plan. By the way, for all purposes, presumably you've got a year of service for the 401k bucket as well as the match and or profit sharing and or safe harbor. They will have satisfied that 1 year of service eligibility requirement in 2022. They enter the plan on 1/1/23 because they're no longer a long-term part-time employee. They're 1,000 hours service, 1 year of service employed, so they get into the plan just like anybody else would. Next, we've had a couple of clients inquire about the penalty-free birth or adoption provision in plans. And this is, you can have this in a 401k plan, a 403b plan, or a governmental 457 plan. First of all, it's not required that you offer this birth or adoption distribution feature. It's only permitted. And my recommendation, unless you have one or more employees really pushing you on this, I would probably hold off with making it available in your plan, if you're so inclined to make it available in your plan at all, until we get a little more guidance from the IRS, which I'm hoping will come sometime this year. So here's what we're talking about: is the plan can, but again is not required to, allow a participant to receive a qualified birth or adoption distribution. And it can be from all sources. So for example, if you've got a 401k bucket and or a safe harbor contribution bucket, you can only get that money on termination of employment, age 59 and a half, or hardship. Well, if you offer this birth or adoption distribution feature, that's another reason why a participant can receive distribution from those sources. Now, even though a birth or adoption distribution is taxed like any other distribution, it is exempt from that 10% early distribution penalty. So if I'm under 59 and a half, I've got an adoption or birth, I want this birth or adoption distribution, and I get taxed on it, I don't get hit with that 10% penalty, even though I may be under age 59 and a half. A couple of caveats here: that birth adoption distribution needs to happen within 1 year of the birth or adoption, and that birth or adoption distribution can't exceed $5,000 per birth or adoption, and a couple can actually receive $10,000 per birth or adoption. So let me give you an example. My wife and I, we have twins. We're both in 401k plans. Both plans offer these birth or adoption distributions. I can receive $10,000 birth or adoption distribution from my employer plan. She can receive another $10,000 birth or adoption distribution from her employer's 401k plan. That's $5,000 per twin for each of us. And so it's $5,000 per birth or adoption. And the wrinkle here is that a participant can repay or recontribute the birth or adoption distribution. So I receive a $5,000 birth or adoption distribution. I can repay that distribution to the plan at a later date. There is House legislation to put some parameters on that recontribution repayment, and we're also waiting for some IRS guidance on exactly how it's going to work. Now, let's say, for example, the plan does not allow for a birth or adoption distribution, or actually it really makes more sense in an IRA context where I can get my money at any time for any reason, and I decide I'm under 59 and a half, I've had a birth, I can come out of that IRA and treat that on my tax return as a birth or adoption distribution. I get taxed on it, but I don't get hit with that 10% early distribution tax. Another major change that Secure Act made was increased the RMD age from age 70 and a half to age 72. So anybody attaining age 70 and a half on or after January 1st of 2020 is now playing under the new age 72 RMD age. And so in an employer plan, the RMD rules say need to start receiving the RMDs if I'm a non-5% owner of the company. In other words, I don't have any ownership in the company, or I own less than 5% of the company, then I need to start receiving minimum distributions the later of termination of employment or age 72. And of course, as you know, it's really the April 1st of the year after the later of these two dates where I have my required beginning date. As far as amending plans for the Secure Act, if you've got a qualified plan or a tax-exempt 403B plan, it's the last day of the 2022 plan year. If you've got a government qualified plan or a public school 403B plan, the amendment deadline is the last day of 2024 plan year. We do not have our plan document provider has not provided us with a Secure Act amendment yet, and that is because our plan document provider is waiting for the IRS to provide additional guidance on the Secure Act. What our document provider doesn't want to do is draft a Secure Act amendment and then have the IRS come out with guidance that contradicts some of those provisions, which would require a follow-up amendment. And so we are at Union Bank waiting for our document provider to give us the amendment so we can give it to you. I expect that'll happen sometime the first part of next year, again, hoping that the IRS issues guidance on some Secure Act provisions before the end of the year. So that is kind of a look where we're at with the Secure Act, and you will see some of these themes continuing with the proposed legislation. So first, I want to talk about the House Secure 2.0 bill. Technically, it's called the Securing a Strong Retirement Act of 2021. Everybody's calling it Secure 2.0. It's a bipartisan bill that was approved by the House Ways and Means Committee, and I think that was unanimous in that committee, May 5th of this year. So strong bipartisan support is expected in the entire House for this bill because House Ways and Means had strong bipartisan support, and I suspect it'll be the same when it finally comes to the entire House. Now, there's a bill in the Senate that has a lot of overlapping provisions as House Secure 2.0, and that's the Retirement Security and Savings Act of 2021, what I'm going to call the Cardin-Portman bill. And it's important because Senators Ben Cardin, Democrat from Maryland, and Rob Portman, Republican from Ohio, have a real strong record of tackling retirement plan issues and putting forth bipartisan retirement legislation. And I think this Senator Portman is not running for re-election, and so I have heard that reading and such like that, that he really wants to get this last retirement legislation across the line. It was introduced by the senators in May this year, and as I said, there's a strong overlap between House Secure 2.0 and the Senate Cardin-Portman bill. What are the chances of becoming law? Well, I have no idea. Earlier this year, the retirement industry was buzzing about how it's going to be very likely that the Senate and the House would come together with House Secure 2.0 and Senate's Cardin-Portman. But from what I can tell, neither of these bills have gone to the full House or the full Senate. Even though there's said to be broad bipartisan support both in the House and the Senate, there's other big fights going on in Congress right now with the budget and infrastructure bill that, floor space and such is becoming at a premium. We're already in mid-October. What are the chances, even with broad bipartisan support? I don't know. It could be one of these things that it gets jammed in some sort of spending bill before the end of the year, but we will have to see. But if it doesn't become law this year, I certainly think there is a decent chance that these House and Senate can agree on these two bills. So that said, there are provisions in both bills that are not necessarily in the other bill. And so what I want to do is spend some time looking at the similarities between House Secure 2.0 and the Senate Cardin-Portman bill, because I think it shows that with this significant overlap, it should be an indicator of what is palatable both to the full House and the full Senate, with these folks working together and have strikingly similar bills in a lot of different areas. So first of all, again, remember, one of those policy objectives for Secure Act is we want to encourage small employers to have retirement plans. And so both the House bill and the Senate bill would enhance the current small employer startup tax credit. Right now, we've got that $5,000 max out rule, but there's always this cap of 50% of qualified plan startup costs. The House bill would increase that 50% of startup costs to 100% of startup costs if you're an employer with 50 or fewer employees. On the Senate side, it would increase the current 50% of qualified plan startup costs from 50% to 75% if you're an employer with 25 or fewer employees. Also, just like Secure, the initial Secure Act, we're seeing this, I think, trend of creeping up on the RMD aid. And I have been asked, hey, is that because people are living longer? I think perhaps, but I think a more important reason for this is kind of keep in mind what's happening is that there's a lot of folks that are working later and later in life. And if you require, and the reason why they're working later in life, some of them are because they need the income, and it seems to be shooting them in the foot. If, for example, I'm 72 and I still have to work because I don't have enough money saved up retirement, and I have to start taking RMDs out of my traditional IRA, I've kind of defeated the whole purpose of putting off retirement and let my retirement savings be for a later date. And so I think that's the reason why we're seeing this increase in RMD age. And in the House, we're going to gradually increase to age 75, step up to age 73 RMD age in 22, step up to age 74 in 29, and finally hit age 75 in 2032. On the Senate side, it just jumps to age 75 beginning in 2032. But I think this is a trend. I think at some point it is going to increase from 72 currently to 75, and I think it's just a matter of time and what type of schedule that's going to do. The catch-up limit is also set to increase. So right now, for example, the age 50 catch-up for employer-sponsored plans is $6,500. Again, worry about this, I don't have enough money for retirement and I'm finally old enough where I can put a few more bucks away. Congress looks like they want to give older folks more of an opportunity to save more money in their employer-sponsored plan. So the House Secure 2.0 says, hey, if you're age 62, 63, and 64, you can bump up from the current $6,500 to $10,000, but then it phases out at age 65, which seems like a quirky provision. So at age 61, I can do my $6,500 because I'm over 50. At 62, $10,000, 63, $10,000, 64, $10,000. Then at 65, I'm back down my $6,500. Senate, on the other hand, seems to have a more reasonable approach and says, hey, if you're over 50, you get that $6,500. If you're 60 and up, you're going to get $10,000 and no phase out at age 65. But again, the trend is to increase the catch-up limit for older folks. Another provision that appears in both the House and the Senate proposed bills I think is intriguing is this concept of making matching contributions based on student loan payments. So here is what Congress has been told. Young folks come out of college, they have a whole lot of student debt, so instead of being able to participate in the 401k plan, they put their money toward student loans, which means they can't get into the 401k plan, and if there's a matching contribution, they're leaving money on the table. And so what both of these bills would do would be to allow me, let's say if I make $1,000 in student loan payments in a year, I can actually receive a matching contribution based on the student loan payment that I made. Now, I think it's a neat idea. It would not be required. It would be optional. Clearly, providers and employers would have to put some sort of infrastructure in place to know when a participant made student loan payments, but I do think it's an intriguing idea. The other thing that's a little bit intriguing is this financial incentive for making elective deferrals to a 401k or 403b plan. So right now, the qualified plan rules, the retirement plan rules, say that I can receive only a matching contribution if I make a 401k contribution. So for example, my employer can't come to me and say, John, we really want you to be in the 401k plan. And I'll tell you what, if you've been to the 401k portion of the plan, I'm going to give you a gift card. Well, that is prohibited against the rules. Well, both the House and Senate bills would say, hey, you can provide some type of de minimis financial incentive for getting into the 401k plan. So I would expect some employers, either out of paternalistic reasons or because they want to boost deferral percentages past non-discrimination testing, I can see them handing out gift cards for participating in the plan. And then finally, this not finally, but long-term part-time employees, we talked about under the Secure Act, we've got 3 consecutive years with at least 500 hours of service. Both bills would reduce that to 2 consecutive 12-month periods. So keep an eye on that, especially if you have part-time employees, for example, that have typically perform at least 500 hours of service for you, but not necessarily 1,000 hours of service, and you require 1,000 hours of service to get into the plan. Another, I think, real good change, I don't know how many folks are aware of it, but there is a huge excise tax, a 50% excise tax for failing to receive required minimum distribution. So let me give you an example. Let's say this year I'm required to receive a $40,000 RMD. I'm not aware of the rules, or I just say, forget it, I'm going to take it this year. Technically, there is a 50% excise tax or $20,000 for failure to make that RMD. That is a huge bite. Reasonably, I think both the House and Senate bills would reduce that to 25% and reduce it to 10% if that failure is corrected within 2 years. So, for example, I need to have my $40,000 this year. I would have 2 years to finally catch up with that $40,000, and as long as it's corrected in that 2-year period, we bump that down from 50% to 10%. Which brings us finally to the Build Back Better Act. As I said, this is part of the Democrats' $3.5 billion budget reconciliation bill. Unlike what we've been talking about up to this point with the Secure Act that's in place now, with the House Secure 2.0, and with the Senate Cardin-Portman bill, Build Back Better is partisan. In fact, I don't think any Republicans on the House Ways and Means Committee supported it, and I think there might have been a couple of Democrats on the committee that also voted against it, but it did get out of the House Ways and Means, but it still has a long way to go. There's concerns over cost, and it's unclear what the Senate will do. And of course, the fight really isn't over retirement plan stuff. It's all that other stuff that's in that budget reconciliation bill. And so it really isn't clear at this point what's going to happen with this Build Back Better Act. I think clearly everyone expects it trimmed from $3.5 trillion to what? I don't think anybody knows. And does that mean the retirement plan provisions survive or not? We'll have to see. So here's what's going on, and here's what the Democrats are responding to, and frankly, what industry trade groups are pushing Congress to do, and what I call making the case. And so Brian Graff, who's the executive director and CEO of the American Retirement Association, a huge association of pension practitioners, sent a letter to the House Ways and Means Committee chair and said, if you pass Build Back Better, at least the retirement plan provisions in Build Back Better, it would add $7 trillion added retirement savings over the next 10 years. It would add 62 million brand new retirement savers, and 98% of those new savers would earn less than $100,000. Now, to the extent that workers really have angst of saving for retirement and having enough, that's what groups like the American Retirement Association are saying. Hey, you can make a huge dent in the so-called looming retirement crisis by passing Build Back Better. We're going to talk about some of those provisions that do that. Now, what's happening in Build Back Better, and we're going to talk a little bit about the required automatic contribution requirements in Build Back Better, and really what would be happening at the federal level is what's already happening in a handful of states that have the so-called automatic enrollment payroll deduction IRAs. And Oregon Saves might have been the first one. I think it's been the most successful one. But again, if we're making the case for Build Back Better, that's what trade groups are doing. Taking a look at the August 31, 2021 report from the Retirement Savings Board, there are in Oregon, not the most populous state, but Oregon, there's 7,647 employers that are making payroll contributions to IRAs. There's almost 112,000 employees with an Oregon Saves account, and there are $131.5 billion in assets in the Oregon Save Plan, and those are dollars that are going to be made available at retirement that otherwise wouldn't be available at retirement. And how Oregon Saves works it is you start at a 5% payroll deduction Roth IRA and you step up to 10%. And I think it's only a matter of time until the federal government gets into something like this to what they believe to help alleviate the retirement crisis. And we'll see how they think they're going to do it. What are the chances? I have seen that some folks think there's a very good chance that the retirement plan provisions are going to survive in the budget package. There's no doubt that I don't think there's going to be any doubt that that $3.5 trillion is going to get trimmed back. How much of that retirement plan provisions are going to stay, I can't say. It doesn't look like that retirement plan provisions are a hot topic, but we will have to see. Something that I thought was interesting, there's a bunch of IRA provisions in Build Back Better aimed at curtailing high earners in their IRA accounts. I'm really not going to talk much about that. But here is something I found interesting. It would be a new RMD rules. In other words, we've got our age 72 RMD rules. This would be a new RMD rule that would apply at any age for high income tax earners with big account balances. And both of those conditions would have to apply. Your high income tax earner would be $400,000 for a single filer, $450,000 for a married filer, and our taxpayer has an aggregate of more than $10 million in employer plans and IRAs. Doesn't matter if that's as a participant or a beneficiary. So high earner, high account balance, and what would need to happen would be there'd have to be distributions of 50% of value greater than 10 million bucks. There'd be a mandatory 35% federal income tax withholding. As I said, it would apply at any age, just not 72. You basically take a look at account balance on a year-by basis and you distribute out half of whatever's greater than 10 million bucks. There would be a special rule if the aggregate account balance is greater than 20 million bucks and there are Roth contributions in there. And let me work through an example of how this would work with Roth. So let's say we've got an account balance of $20,500,000. There's a Roth account in there. So we're up over $20 million in the aggregate, so that bottom rule applies. We play these special Roth distribution rules. Our participant, high earner, over 20 million bucks, has a $500,000 Roth account balance. We automatically distribute that out to get down to our 20 million, and then we would take 50% of the account balance that exceeds 10 million bucks. And so that'd be 20 million bucks, 50% of, 10 to 20 million bucks would be 10 million bucks, half of that, 5 million bucks. So this would be a $5.5 million RMD payment made. And it doesn't matter whether our participant is 32 or 72 or somewhere in between or younger than that. And going back, just under the $10 million rule, let's say we've got $11 million in our plan and we don't have this excess $20 million with Roth account. Let's just say we've got $11 million in there. We're $1 million over our $10 million. That'd be a $500,000 RMD out of that account. And clearly, this would be what would be considered a pay for, is because there's other legislation that would cost the fisc money, and this is one way to get some of that money back. Now, what is in there? Well, Congress loves automatic contribution plans. And the House Secure 2.0 has some automatic contribution plan provisions in there. The Senate Cardin-Portman bill does not, but the Build Back Better Act would require an employer to establish an automatic contribution qualified plan or an automatic IRA arrangement, and that IRA arrangement basically be a payroll deduction IRA. The employer will start at 6%, step up to 10% over time, automatic contributions, no greater than 10% coming out of the gate, and can't go over 15% when you start stepping up. At all times, though, even though the employer would be required to offer this, employees at any time under any plan can always opt out and say, no, I don't want to do anything at all, or I want to do less than 6%, or I want to do more than 6%. Also, On the employer plan side, not the automatic IRA side, if you have a participant with more than a $200,000 vested account balance in the plan, you would need to offer a lifetime income feature for at least 50% of that account balance. So if I've got a $300,000 vested account balance, at least $150,000 of that, I must be able to have access to some type of lifetime income feature. If I have a $150,000 vested account balance, you don't need to offer me a lifetime income feature. And when we're talking about a lifetime income feature, we're talking about some sort of annuity product or some sort of guaranteed minimum withdrawal product. Now, how is the government going to force this through an excise tax? Now, I kind of want to let you know is not everybody will have to do these automatic contribution plans. So, for example, if you're in a state law type of program, Nebraska doesn't have it, but for example, an Oregon Saves program, you would not be subject to an excise tax. It also would not apply to government plans or church plans. It would not apply for very small employers. That would be 5 or fewer employees with at least $8,000 or $5,000 of compensation. If the employer has been in existence for fewer than 2 years, you wouldn't have to worry about this. It also does not apply to any employer with an existing plan. And so what we're really talking about are new employer plans effective in 1 of 23, which seems to me a pretty short time frame to put the infrastructure in place, because now all of a sudden you're going to have, remember at the top of the program, if we believe that statistic, less than 50% of small employers, and that's employers with less than 100 employees, have retirement plans. Well, you know, those employers are going to have automatic enrollment types of plans and pretty quickly. Big penalties, $10 a day per employee. We cap at $500,000 as long as you were reasonable cause for failing to comply. Bottom line here is Congress loves automatic enrollment, and so I think that is a trend, and I think we're going to see more and more provisions to do with automatic enrollment. Build Back Better also would have a brand new type of plan called the deferral only arrangement, which would satisfy these automatic contribution plans. No employer contributions would be allowed. It would have to be start at 6% coming out of the gate, automatic enrollment going up to at least 10%, but not more than 15%. Plan would be deemed to satisfy the non-discrimination testing rules, deemed to satisfy top-heavy rules. As I said, no employer contributions would be permitted at all, and it'd be lower contribution limits, and they would actually be the IRA contribution limit, $6,000 plus the $1,000 age 50 catch-up, as opposed to our 19.5 401k limit and $6,500 additional for catch-up. So this concept of deferral only, they could adopt that. Also, again, kind of keep in mind, we want to encourage, or rather the policy behind Build Back Better is we want more employers, small employers, to adopt these plans. And if we're going to adopt plans, Build Back Better would increase our tax credits. The tax credit that we've been talking about, that $5,000, would be increased for a 5-year period. However, after 1 of 23, it'd have to be an automatic arrangement. And also, we would be bumping up that 50% of qualified startup costs to 100% if you were an employer with 25 or fewer employees with compensation of $5,000 more. And there'd also be this new small employer automatic contribution tax credit So again, remember under Secure, we've got $500 tax credit that you can get by adding an eligible automatic contribution arrangement. Build Back Better would extend this credit to the automatic payroll IRA deduction plan. It would extend this tax credit to deferral only arrangements, and that $500 tax credit would be for 4 years and available to 100 employees with $5,000 more of compensation. That would be effective 1/1/22 if they pushed it through. So with that, I have reached the end of my prepared remarks. Again, I don't know that anybody knows what are the odds that some or all of this is going to get passed into law. Devil's in the details, of course, with everything, but I do think, as I said at the top of the program, that it's worthwhile taking a look with a kind of a broad brush of what's going on with Congress, and you can see some trends that kind of, I think, gives you a peek at where I think we're headed in the retirement area. So with that, I'd be glad to answer any questions that I can. Again, alternatively, feel free to call me or email me at any time if you have questions about proposed legislation, about retirement plans in general, about your specific plan. So I appreciate your attendance. Thank you.
Yeah, it doesn't look like there's any questions. And so just to also wrap up and let you know, first of all, thank you everybody for joining us today. We are going to post a recorded version of one of these sessions within the next week or so on Plan Sponsor website. So again, one more time, if nobody has any questions, we're going to let you guys go and appreciate your attendance today. Thank you.